Good morning, ladies and gentlemen. Well, the risk dial is still very strong, as strong as it's been for many years, and that is the way it should be because the market is making new all-time highs. I am just beginning to be very skeptical when we reach mathematical targets that we've been looking for a long time. As you know, I've been saying 22 times multiplier for a 215 S&P. That forward earnings, that gives you 4,730, and that is where we are within a whisker. So I think things are going to get harder from now on, and that is the title of this video. There is absolutely no reason to believe that we will have anything more than a run-of-the-mill retracement. If we have one, there is absolutely no reason to sell. But I will now examine some reasons why we should be more skeptical at these levels. And with that, we'll start with the yield curve and what it's been showing all along and why it might be changing. Well, this week we had the FOMC. The week before we had the ECB. So basically we've had everything that we are likely to have that is meaningful from the central banks until year end. They have slightly pushed back against the market's bearishness in terms of very short yields and how quickly rates will start going up. But that does not mean that rates will not go up at the speed that the market was forecasting earlier. If basically we're going back to a data-dependent Federal Reserve and ECB to a certain extent. So, you know, we are not out of the woods in terms of the yield curve in or the individual tenures by any stretch of the imagination. We just are buying some time in which data can percolate through and give us the next big direction for the yield curve. What happened in 2s10s? Well, really nothing. It closed within 3-4 basis points of where it opened the week. I still think that the next big move in 2s10s is going to be to the downside, but I think in the next 3 or 4 weeks, until at least December FOMC, we're going to see very little in terms of movement in 2s10s. I still think that if you see it in the 120s, it is a very good short. Because the risk reward becomes very good. Around 124 to 128, the risk reward for the downside is massive. Either we have inflation or we don't have inflation. If we don't have inflation, you know, I still can't see this yield curve being very steep. So to me, anything in the 120s is a sell in terms of 2s10s. In terms of the other tenures, I really don't see any particular reason why we should flatten the yield curve more, especially in 5s30s and 10s30s. This is the weekly 5s30s. As you can see, we've come back to this 83 to 85 level. To me, this is natural. We've had such a big move, such a big flattening move, which gave us the risk on, and you know the last big push in equities and enabled it, and we've reached all the targets. To me, it would be very, would I want to be in a flattener in 5s30s at this level? I really don't think so. Yes, could it go up to 56? Yes, it can. But I really don't see any immediate reason for it. I think there are far too many unknowns. The Fed has done what it's going to do for the next, I don't know, at least 1 month or two. We don't know if they're going to start accelerating the taper because of data. To me, it would be absolutely normal if we revisited these levels around the 100 basis points. That is not a huge steepening of the curve, but it's just a give up to what we've done. And if we look at the 10s, 30s, a period of consolidation such as this would be perfectly normal to me. Something, a move back towards the 55, something like that. I really don't see why, that would be out of the question. Do we have any reason to believe that we are going in any kind of recession? No, the data just doesn't support that. The data is strong. Yes, the market needs duration, but that does not mean that we go in one way. So I'm becoming very skeptical as to what the yield curve will be doing for the next month. I think probably very little net. But in the meantime, it can spit people out one way and then the other. And that is why I'm beginning to be far less certain of the immediate prospects for the risk markets. That does not mean that I'm bearish. That does not mean that I want to put on huge steepeners here. It just means that while the risk reward here was great, the risk reward here was still good, up here the risk reward is decidedly average, if not bad. If we look at the individual tenures, I think the safest play is to be short futures in the 2s. When we reach this area and we fill this gap, we're talking about 30, 31, 32 basis points. The risk reward there is going to be excellent, simply because we have a natural stop below 27. And even then, all you're looking for is to put it on at better levels. I mean, let's face it, what the Fed has said is that they are now data dependent. As I will show you later, the prospects for companies are good. If they are good, it means that the economy is working well. It means that companies can afford to hike wages for their workers, and that is just not going to be very positive for inflation trends over the shorter term. I really find it very difficult to believe that the Fed won't lift off in, say, June, July of next year. We have an awful long time to go before then, and the market will squeeze people both ways. But I think that when we get down to here in the 2-year note, the risk reward of doing some options to the upside is actually overwhelming. In 5s, I think the odds of the market trading much below 85 are probably very, very low. It might just trade between 85 and 97 and 85 for a little bit. And then the risk reward is again to the upside. So that's for the short end. 10s and 30s, and this is now 10s, are actually very neutral and will remain very neutral. I think the yield curve is going to move at the short end. So the 10-years that will move are going to be the 2s and the 5s, and the 10s and 30s are going to be very, very stable and basically trade. I would have thought that over the course of the next 6 weeks, we're going to be trading around 139 basis points, up and down a few basis points. That is all I can see in the 10s. And in the 30s, they're actually looking, again, I would have thought that, we will be around this 180 level, 176 to 190 area, trading for quite some time, which basically tells me that the market is in equilibrium at the longer end, and all the movement in the yield curve and in the individual 10-years is going to take place in the 2s and 5s, depending on the data that we get. if we get data that shows that inflation is still a problem and continuing to accelerate, it will be seen in the 2s and 5s and much, much less in the 10s and 30s. The terminal rate there seems to be pretty much stuck. It would have to be a very, and determined, it would have to be very interesting, to use a word, i.e. very, very bad data to unlock the 10s and 30s. They really seem to have decided that really around 2 is your terminal rate in the very long end, and that you're not going to see it much higher than that. That continues to support the risk markets. It would, we really need to have some very bad data that unlocks the 30s towards 250 for risk to suffer considerably. As far as Europe is concerned, I want to start with this chart of the differential between bunds and 10-year notes. It's basically been stuck in this trading range of 10 basis points for the past couple of months. I think which way it eventually breaks is going to be very interesting. I would have thought that the dark horse is that it breaks to the downside, and that is what nobody is expecting. So I'm, I really don't know. Naturally, can it break to the upside? Yes, it can, and I'll probably go with it. I'm not doing anything in that differential. I'm just looking at it and trying to figure out the pieces of the puzzle, because it doesn't make any sense that it's been stuck in such a in such a small range for such a long time. Especially because we know that the one that's pushing back against higher rates most is our friend Christine Lagarde and the ECB, who are as dovish as as it could possibly be. And yet the market is not breaking higher, is not taking these differentials back towards the 200 area. When the market does that, I always get very skeptical as to why, and I'm actually not really, I can't answer the question even to myself, let alone to you, and therefore I'm just noticing this pattern rather than trying to say what it predicts. To me, it predicts, if I gun to head what it's saying, it could possibly be saying that that Europe and inflation in the US are very much tied together, and the ECB can be as dovish as they like, but if inflation is a problem in the US, it's going to be just as much a problem in Europe, and at some stage the ECB is going to have to change its tune. That is what I think it's saying. I'm by no means certain and still want to look at it. But I will definitely go with a break of it either way. I would prefer it to break down, because then I would really understand what it's saying. If we look at bobbles, they did, the pushback from the ECB was had its desired effect. You can see how it's come off from the level that we had just after the coronavirus panic. And, I'm looking for this kind of level between around 62, 63 basis points. That equates to 135, 35, 40 in the futures, and that's always been very, very good support. And if you don't get it there, you get it, a little bit lower. But I think the risk reward in this area, whether it's 135.40 or 135.70, 80, the risk reward in this area for a move back up is enormous. As I said earlier, the ECB is going to have to change its tune at some stage, because inflation is worldwide. It's not just in the US. So to me, this area offers very, very good risk reward. Just like this is now Bunds, and I'll go back in time, as you can see that this area around 36 is going to offer enormous risk reward in the days to come. I really don't see a reason why we should go much below there. We are still in a, to me, this is a pure reaction to the pushback we had from the ECB, that the market, is going to stop at some stage, probably right here around the 36 area, and then we have another leg higher. I just see no reason for it not to happen. France is even clearer. It around 0 is the level that it is likely to bottom and then have another go to the upside. I prefer to be playing these European yields to the upside because there's no, to me they're just walking risk, because every time we get a piece of bad data on inflation, the move to the upside is going to be so much greater than this pushback if you get it at a good risk reward point. I've been doing quite a lot of thinking about what the dollar is saying, and I think the dollar is saying that it's a passenger, that it's not the dollar that's doing anything. I think it's more the euro, I think it's more sterling, I think it's more yen, which are being weak rather than the dollar being strong. I think the dollar is just, I think the DIX index is just a reflection of how weak the other currencies are. And the other currencies are weak because of the greater pushback that their central banks are giving to tightening rather than the Fed. At some stage, that implies higher dollar levels. And in the meantime, it implies a sideways trading market until the data shows what it needs to show. To me, still 93.14 is going to be the bottom of the trading range in the dollar, and that basically says that Euro USD is going to move sideways. If we have a look at Euro USD, it still can't break below this and close below this 115.43 level, and it just keeps on bouncing off it. But the bounces are very, how can we say it, uninspiring. Can it get back up to 117? Well, probably, but it looks more and more like the dollar is going to continue the stronger phase that it's having, simply because the other currencies are weak. We can even have a look at the pound, and that one is the one that's being more and more showing weakness. This is a monthly chart, and you can see that if we start breaking really this 135 area, likelihood is that the pound goes all the way back down towards these kinds of level around 124. So my conclusion is that it's not the dollar that's so strong. I think it's everything else that's so weak. The stability of the dollar and the stability of the bonds that basically have telegraphed that 2% is your terminal rate at the very long end, which would imply that 1 to 1.25 is your terminal rate for the short end, if we're going to have a normal yield curve, actually is beginning to make gold look more attractive than it has been for quite some time. If we enlarge this area here, we can see that we are still not breaking the 1830 to 1850 area, but you know, we are now beginning to trade above these weekly moving averages, saying that this area is very, very key. I'm turning more positive towards gold simply because I can't see any big movements in bonds that will affect it adversely over the course of the next several weeks until year end. There doesn't seem to be any reason for it unless CPI is way out of line, but there's no reason to think that it will be, which makes gold slightly more attractive over time. If we change this to a monthly format, you know, it basically is saying that if we start breaking these monthly highs around 1838, there is absolutely no reason why we can't trade up here towards 1912, and that is, you know, and that is the likelihood that it happens. Basically, you can see, you know, I really, you know, the fact that we've basically rejected this 1710 area so many times, to me implies that, you know, we break towards higher levels. If we look at the dailies, we're beginning to trade more and more above the 200-day moving average. Still needs time, but I would have thought that the trend for gold, unless things dramatically change in the dollar and bonds, is now beginning to be slightly higher, away from this 1764 pivot, certainly towards this 1880 to 1910 area. DBC continues to do what it should do. It's taking a breather at this area. As long as it is still above 1950, any dip is a buy towards 1950. I am absolutely positive it's going to have yet another leg higher, and that we're not seeing it top out for the time being. Why? I mean, am I 100% positive? Well, I can be positive while oil remains above $17. While all it does is like make small retracement to basically these levels where it spiked the Bollingers on the weekly basis. Don't forget, these are weekly charts. As long excuse me, as long as it stays above $75 and it keeps on closing above $75, I think the pressure will be for higher prices over time. If we go back to the DBC chart, you can see how similar they are. This would basically means that any kind of a dip down towards these kind of levels, 2022, it's time to buy call spreads for a move up to 24. And while this keeps on being the case, I really cannot see that change, that we will want to lower the terminal rate of long bonds. And if we can't lower the terminal rate of long bonds, at some stage the short end of, i.e. the twos, become very unattractive. The very short end of the yield curve becomes very unattractive because it gets closer and closer to the Fed having to respond to the continued inflation, and that will eventually make twos go towards the 1% range. It's going to be glacial because we have something like 6 to 8 months before the Fed will act. But the pressure that the market is going to continue putting on the Fed is, I think, going to be continuous unless we get some very weak inflation data, which at the moment I just can't anticipate. If we look at at copper, I know some of you like trading it. We'll look at the daily. I mean, we are still trading above the 200-day moving average. We're in a great big range. We've broken above the very important 375 area. We're still in a great big range. I think it's, do we have to expect it to go up right now? No, but it's not saying, sometimes you get great big divergences between bonds and copper, and I know some big guys like to trade them, but we're not getting those great big divergences. We're basically saying that we are trading in this range, and we will consolidate in this range for a while. That just does not tell me that it's any kind of a signal for bonds. So as long as it's between 375 and 417 and not lower than that basically it just does not tell me that it's a bearish signal for bonds. So I really don't see that copper is giving you any signal at all that is bearish for DBC or for oil or for the economy. I think it's just basically waiting around, and then it'll make new highs sometimes towards year end or next year. I just cannot get bearish of any commodity because there are just no signs that one should be. I want to start the equities part by looking at a very good email from Top Down Charts, which I subscribe to, just giving you the earnings surprises. You can see how the earnings surprises are to the upside as much as they have been for, well, forever kind of thing. And the earnings trend, we are back to the earnings trend. And if we have a look at profit margins, they are at new highs. What does that tell you? That tells you that the likelihood is that the current $215 per share forward earnings is likely to be revised up, because that is what analysts do. And it also tells you that, we looked at bonds earlier. It tells you that we are unlikely really to move away very much from that 22 forward earnings. Let's have a look if we can get rid of, no, well, okay, so I'll have to do another chart. But what that is basically telling you is that the likelihood is that we revise things upwards and that we remain strong. But I have certain, I'm very skeptical at these levels, simply because, it's just too much of a good thing, and I'll explain to you why in a moment. So the Blue Angels, as I'm saying, the likelihood is that towards year end they keep on revising these forward earnings higher and higher, because they're just going to go with the trend. They're saying, well, we've had the higher margins, we've got the everything is going great, but to me that actually implies that the likelihood, the probability of companies giving in to wage demands is actually greater. You can't go into a negotiation with unions and say, oh my God, everything is awful, when you are beating profit expectations, earnings expectations, you have the highest margins in history. That argument's just not going to wash. And that, if they start increasing wages at a faster pace, that is actually going to be bearish ultimately for forward earnings. So I think that we are entering a period of higher volatility of returns, because it's too good. We've already had everything that we're going to, or most of what we're going to get in terms of earnings surprises. And now if you start revising it even higher, the likelihood are that we are going to be very disappointed at some stage. Doesn't mean anything happens in the next couple of weeks, but when we start reaching targets like 4,730, which is a very optimistic 215 times 22, which in itself is a high multiple, I have to start thinking that it will pay at some stage to be skeptical here. Right, so back to my cleanest S&P chart. And the problem with the way that we've gone up is that now I can't draw any support, any real meaningful support before 45.37. There is just nothing. And that is what worries me. At some stage, I'm pretty damn sure that we're going to have a revisit of that level. I just can't think why. As I said, as I showed you earlier, earnings, profits, margins, everything is wonderful. And that is when I start getting worried, because things are too good. They've been too good for too long, and we've got there in such a hurry. Okay, so maybe I'm being, sort of overly cautious. I do know that they're going to be revising these earnings probably to 220, 225, which gives us targets in the 4800s. I know it's November. I know November and December are traditionally the highest months with the strongest seasonality. So maybe I'm being stupid. But to me, volatility is actually beginning to sound a bit of a warning. And this structure I just don't like. But that is not a reason to sell. That's just a reason to maybe have some hedging on board. The other warning sign is that we are way above the Bollinger Bands, and every time we've done that, we've entered a period of several weeks in which we retested that break of the Bollinger Band. And that break of the Bollinger Band is here at, what is that, 46 20s, 30s, okay? This says 46.38, 46 20s and 30s. That will be the level that I think dips are going to be contained to for the time being. But if not, 45.35 on the weekly is going to be very, very difficult to break. So what would be a sensible strategy? A sensible strategy would be to exchange longs for call spreads, and really every time it dips to, first of all, 46.30s, or even better, 45.30s, you buy the call spreads again. So that would be the most sensible strategy, to replace outrights with something which gives up very little by having some built-in optionality, and I'll of course discuss that on stream on Monday. Everything has broken out, but everything has broken out in an, at the moment, unhealthy manner, because everything is way above the Bollinger Bands, and every time it's done that, it's basically retraced, and i.e. it spat people out. This is NDX, and of course even TF, the IWM, which is the Russell, which has been in a range for a year, has broken out, but it's way above the Bollinger Bands. If we enlarge this, we will see by how much. All this says to me is that at some stage, will we continue to be bullish? Yes, we will. But at some stage, we will spit the people who bought up here out and stop them out. That is my only worry, really, that we have some kind of a shock which gets people stopped out again down here, just straight below the line, fill in all the stops and then go again. That is the kind of worry that I'm having. Even the transports, they closed at all-time highs. The Dow Jones closed at all-time highs, but the Dow is much healthier in the way it's trading than the other indices. The other indices are so way overbought, it's not true. And that is what worries me, that you should sell the news. You buy the rumor, you sell the fact. We are at the fact of 215 times 22. And that is what worries me. But I'm certainly not bearish. I certainly don't want to short it. I just want to buy it at better levels. Maybe I'm being a pig, but I'd much prefer to have option strategies that don't bury me on 100-pointer in ES in a day. And that is what I'll discuss on stream on Monday. VIX is the one that's probably, if any of them is giving a warning, because it just can't stay below 1558. And if you can't stay below 1558, that to me indicates that probably an option strategy at these levels rather than an outright strategy is the better course of action. I would not be surprised to see a quick spike up into the, to 20 to then spit everybody out again. It's just what the market does. And the problem is that every single market, if we have a look at the DAX and the stocks, they're all breaking out. Every single one is telling you to be long. On the monthlies, basically in stocks, you have nothing until 45.12, which is my ultimate target. Everything is breaking higher. Everything is breaking higher in a very fast manner. Everything apart from the UK, which just can't get going, and Germany, which just can't get going either. Basically we are where we have been for many months, within 1%. And that to me says that certain markets have gone too far, and probably the US has gone just a little bit too far to reach these targets, and everybody's long and everybody's euphoric. And if we get one bad number, you could get volatility spiking, and that basically makes the market go down 70, 80 points, i.e. 2% in a day. Everybody gets stopped out, and then the market goes again. I am not worried longer term. I'm worried shorter term that people are just too euphoric. So what have I done with my own portfolio to hedge here, to hedge my bets? Well, I've gone closer to the index. What does that mean? That I've gone closer to the S&Ps and away from NQ, i.e. away from growth. And I've actually gone against the trend, because if you have a look, this is XLK over SPY. It's breaking out of a very, very long consolidation period that goes back to basically July, August. So, that is of 2020. Okay, so this has been a year plus range, which is breaking out. You should be buying this, but I just can't bring myself to buy it, simply because I think that it's 99% in there. And therefore I'm just hugging the index that I think is going to be less volatile, and that is the S&Ps. The S&Ps over the Nasdaq itself, NDX, has not broken out. And that is the one that, it gives me a sense that we might be seeing some false signals with XLK. I'm just not that convinced that we have the firepower to go higher in growth stocks when they are so overbought, and we have so much of the expectations that that are baked in, basically, realized. So that's what I'm doing. I'm moving away from high growth in closer to a less volatile index, and I will be hedging, but I will be talking about these hedging strategies with you on stream on Monday. So on to the my biases. I've updated the levels. I think the only thing that's going to be interesting in fixed income over the next couple of days, until we get CPI and we know what we're looking at, will be to short bobble around that 135, 37 to 40 area. That's going to be a good risk reward, and I think I've got a good option strategy that I'll talk to you about on Monday. Everything else is going to be dependent on what the bad CPI, how bad CPI is, and I'm fearful that a really bad CPI can knock us back here. Am I being a pig? Probably, but when we get to my targets, I always start getting very, very worried that people are getting exuberant for no reason. And the easiest thing in the world is just to up forward earnings for no reason, and then expect everyone, the smart money to follow you. I just don't see why you should follow raises in forward expectations just because your current expectations are being met. To me, that is very, very dangerous, and I think it's going to get hard from here. I think the market is going to spit you out before it rewards you, and I think the returns on your money are going to be much more volatile from now on. But we shall try and hedge that, and I'll talk to you on stream on Monday.